Hi, everyone, and welcome to today's webinar. My name is Anna, and I'm with the New Mexico Small Business Development Center. Today, we have Tommy Thompson joining us, who is a certified SCORE mentor who specializes in business and corporate financial planning and business valuation. Tommy holds an MBA and is a retired CPA and will be presenting Cash is King, Cash Management for Your Small Business. Thanks so much for joining us. And without further ado, I'll hand it over to you, Tommy.
Well, good afternoon, everyone, and thanks for attending today. We're going to talk about cash today. Cash is the lifeblood of business, and you need to know how to keep it flowing smoothly through the business. Today, you're talking to me, of course. I have about a 40-year history of financial analysis and executive jobs in which I've been responsible for cash management in some of them. As far as the presentation is concerned, I'd like to ask everyone to please be sure you've muted your audio so that nobody's pets get on the broadcast by accident. Make sure you set your zoom ratio to fit window. That will bring it up to the full size of your screen and also make the type somewhat more visible and accessible. We'll be using the Q&A function to take questions. If you'd write down your question and the related slide title, not the slide, well, the slide number down in the bottom right corner down here, either the number or the title will be just fine. That way, we'll be able to see your questions and put them in order. I'll try and answer them as they come up. Our moderator, who's off screen right now, will be monitoring both that. If you'd open your chat window, she'll be putting up some information on chat as the webinar progresses. So with that, we want to talk just a moment about other training offerings, consulting, counseling assistance available through SBDC. You can visit the SBDC website at www.nmsbdc.org and then click the workshops and events buttons to view various training events that are available both live and through recorded programs. You can also go to the SBDC website to request no-cost business counseling and also assistance with loan applications to any banks that you may be considering. Those are available at no cost to you, and we encourage you to take advantage of those resources as you need to. Now today, having addressed the first two bullets in this point, we're going to talk mostly about cash flow management. We're going to touch on corporate record keeping because with the pandemic and all the pandemic assistance programs, there are record keeping requirements that you need to have available to you, especially as the government gets goaded into auditing some of the program's recipients to make sure they qualify for the program and to make sure they've got the proper records. We'll take your questions and we'll talk a little bit about next steps based on what you're going to hear today. As we go along, please don't be afraid to ask questions. We'll try and slip in the question and the answers as we come to a quick point with respect to each of the slides. Now, what are we going to learn today? First of all, we're going to find out what is cash flow. First, there are some things that are part of cash flow from an accounting and operations standpoint. There are other things that are not part of cash flow, and it's important to know the differences. We're going to talk about what makes cash flow through a business. Okay, it comes in from customers and other sources. It goes out to vendors and other uses. And we're going to talk about how that flow happens. We're going to talk about some strategic cash flow principles, things to keep top of your mind as you think about cash. And if you're a small business owner, you should be thinking about cash almost all the time. When you're not thinking about customers, you should think about cash. When you're not thinking about production, you should think about cash. When you're not thinking about marketing, you should think about cash. We're going to talk about forecasting cash flow and provide you with a tool to do that. We're going to talk about tactical cash flow management. What do you actually do to speed up your cash coming in and to slow down your cash coming out? And then finally, we're going to touch on record keeping requirements for pandemic relief. Those are the kinds of things you've got to be sure you have when the government comes knocking and says, prove to us that you deserve this money and that you deserved to have the debt forgiven in the case of the payroll protection program, which was one of the major programs during the pandemic. So moving ahead from there, the thing that we want to recognize at all times, and the subject of this webinar, is that cash really is king. It is the lubricant that keeps the wheels of business grinding around. Business goes in a cycle. of money. Money coming in, money going out, money thrown off to shareholders, money coming in, money going off, money sent to shareholders, okay? And that flow is lubricated by cash. Cash accounts for timing differences between needs and uses. Cash accounts for returns to shareholders. Cash accounts for a variety of things. And what it's important to know is that when you run out of cash, you crash. Everything comes to a grinding halt because you can't meet your obligations because you don't have the cash. When you can't meet your obligations, people don't do business with you and your business crashes. So keep that in mind. This is the primary asset that you use to keep your business rolling smoothly. Now, what is it? Yogi Berra had a definition of it, and they pay in cash, which is just as good as money. Yogi aside, the net amount of cash and cash equivalents that come into and go out of a business are its cash flow. Fundamentally, your company's ability to create value for you as the owner is determined by that business's ability to generate positive cash flows over an extended period of time to maximize long-term free cash flow. What is free cash flow? Free cash flow is cash that is not needed to keep the business operating. It's not needed to support receivables. It's not needed to pay vendors. It's not needed to buy capital equipment and goods. It's not needed to pay back loans. It can go to shareholders, or it can go to other business ventures, or it can go into expanding the business, but that's at the shareholder's choice, okay? Free cash, stuff you don't need to run the business as it stands. Now, what makes the cash flow? First of all, it's cash money coming in. If you're in a business that sells on credit, your cash flow isn't the amount of the sales you made on credit last month. When you made that sale on credit, what happened? You sent an invoice, you provided the product, right? Did any cash happen when you did that? No. So cash from money coming in is cash sales over the counter, if you do that. And it's not the new sales on credit, but it's the payments of old sales that are being paid off, collections on accounts receivable. It's also deposits that customers might pay you, or prepayments for future goods and services that you might get from customers. All right? Those are the operating cash flows, the stuff that comes principally from customers. Now, money comes into your business from other places too. It comes in from relief loans and grants now that since we've got the pandemic to worry about. Those are government programs that provide cash to help support business operations when customers aren't able to buy because we're all locked down or because the customers just can't get out to make the payment. Other money coming into the business that's not operating money includes loans from banks, loans out of your own pocket, and loans from family and friends and various fools that might want to be part of your business, that believe in you. Now, the other side of cash flow in is cash flow out, and that has to do with your business operating expenses, first of all, has to do with compensation to your employees, benefits and taxes, payments against accounts payable. In the same way that your credit customers don't pay you right away, you don't pay your vendors right away if you have credit established with them. So it's not the purchases that you're paying for, it's the purchases from last month or 2 months ago that you're paying for when you make payments on accounts payable. It's payments of rent, it's payments for operating expenses. If you're in the manufacturing business, it's payments for raw materials, it's payments for factory production overhead, okay, besides rent, utilities, for example, and those types of normal operating expenses, advertising, marketing, whatever. Now, that's operating cash flow going out. In addition, you also have obligations to pay cash out to things like bank loans, to buy capital equipment to run your business either more efficiently or to expand it. You have cash flow out for the draw you take from your business, whether that's a salary or just a straight distribution of cash. And you also have the obligation to repay or pay dividends or pay interest to family and friends who've put up money for your business. None of that stuff, starting with the bank loans, none of that is part of operating profitability. but it is cash flow. So you can see how cash flow is different from profitability. There are more sources of cash and more uses of cash than are recorded in the income statement of your business. Now, I mentioned earlier sales on credit and purchases on credit. Neither one of those things have a cash flow impact, except down the road a ways. When you sell on credit, you create an obligation from your customer to you. When you buy on credit, you create an obligation from you to your vendor. But the cash doesn't move at the time the goods do. And that's important to keep in mind. That's not part of your cash flow. You can't spend an account receivable, okay? You can't satisfy an account payable without using cash. So this is all what goes into the cash that flows into your business. Now, strategy. The basic strategy for cash flow management is to work at it. It needs to stay at the top of your mind. It needs to be always in your mind, as I said at the introduction. Now, in order to work at it, the first thing you need to do is to forecast what it's going to be. And we'll talk later about how that forecasting process works. And we'll even give you a very free tool to help you forecast your cash coming in and your cash going out. Once you forecast what's coming in and what's going out, then you need to track it. You need to track it so that you can understand the differences between what you thought was going to happen, the assumptions you made about cash flow in, and what actually happened, what actually came in. And you need to investigate those differences to decide whether it's a momentary thing that's going to turn around and fix itself, or whether it represents the need to fundamentally change your assumption about cash flow for the future, for the next cash flow period. Okay? Then we're going to talk about tools to accelerate cash coming into the business, to speed it up, and also to slow down cash going out. Now, you see I've put a question mark after slow down cash out. I know you're thinking to yourself, well, how the heck do I slow down cash going out? All these people want all this money on all these deadlines. There are some techniques we can use, both in the normal course of business and in an emergency, and we'll talk about those. But these are the basic steps for understanding and managing cash flow. You need to forecast it, you need to track it, you need to keep it in your mind, and you need to implement tools to accelerate cash coming in and slow down cash going out, and keep working at it. Now, the forecasting question is fairly simple. It's only 4 parts to it. What cash do you have right now? What's going to come in? Why is it going to come in? Which means do you have to pay it back? And when is it going to come in? The other side of it, what's going out? Why is it going out? And when's it going out? And finally, if you net all 3 of those first 3 things together, what's your cash at the end of the forecast period? Now, most businesses will forecast cash on a monthly basis. When things get tight, or in certain times of the year, they might even forecast cash on a weekly basis. Certain kinds of businesses, like banks, for example, forecast their financial position and their cash flow every day. And they do that every day because cash is at the heart of their business, coming in and going out in huge chunks collectively. So they want to know right up to the moment when it could. Now, one of the companies I worked for in my career was a company that sold products into the spring growing season. It was an outdoor power equipment company. So we would start building equipment for the season way back in the fall, in September, October, November, December, January, expecting that we were going to ship all that product out in March and April and May and June. That was our big season. So we would forecast what was coming in and what was going out to make sure that we knew when and why we might have to go into our seasonal lines of credit. And we actually published this to the company every day to keep everybody's mind exactly on where the cash position was, what the cash position was. And that produced everybody, that produced a real focus on conserving expenses when we weren't getting a lot of sales, and in understanding what was happening and why it was happening when our sales started going out. So forecasting is the critical first step in managing your cash flow. You make assumptions about what's going to come in. You make assumptions about what's going to go out. And then you compare those assumptions to what really happened and either adjust the assumptions or understand that there's going to be a turnaround in your situation somewhere down the road. Now, in your package of slides that you're going to get, there's a copy of this example. And this is a template model to use to forecast cash. Now, it's here, and I've only put half of it in here so you can read it, so that the type is big enough for you to read. But I'm going to cite the source for you to go to get the real spreadsheet and the book that goes along with it that's free to help you manage your cash flow. The book is called Never Run Out of Cash. It's by an author named Philip Campbell. There's a website, neverrunoutofcash.com, where he even offers to let you download a free e-copy of the book, along with a live Excel spreadsheet that looks just like this to help you fill in the numbers that you have to help you manage your cash. Now, this looks a little bit like a profit and loss statement, all right? I say it looks a little like a profit and loss statement. It isn't. There's some things missing from it. First of all, in the operating expenses, we don't have any interest expense. We don't have any tax expense. We don't have any depreciation or amortization expense. And why is that? What we're trying to do here is to look at the operating results of the business, the cash-based operating results of the business, okay? And to do that, we start out with what we've got in cash, and you look up here under January column, and you see $10,000. We've got $10,000 in cash to start. Now, we're going to assume for the moment that this business sells everything on cash and nothing on credit. So the $15,000 of sales actually came in during January. We had a cost of goods sold. Notice we've got a very healthy gross margin that we take out of that. So we've got a gross profit to work with. And then we take our operating expenses out of it. And when we get all done, we've got a number down here on the line that's labeled EBITDA. And that number is a pretty healthy number. Now that number gets added to what we started with, that $905 gets added to what we started with. And at the start of the next month, excuse me, I'm going to back up here. After we account for some other cash needs, our leftover cash is going to get added back to be our February starting cash. So after we get this EBITDA number, we have to think about what other things we need cash for. And they start to come in section 2 of the template model. First of all is debt service. Now, when we owe debt service, this is where we account for the interest. We take out the interest expense, not only the interest expense, but also the cost, the expenditure to service the principal of the debt. Of that $1,100, not very much of it might be principal if it's an early time of the note. If it's a late time of the note, a lot of it's principal, but it's all level payments of $1,100 a month, all right, on that particular loan. Notice Philip Campbell left space for note 2 and other kinds of debt service in here, so you can fill those in and label them the way you want to when you start using the template. Now, the next question is, what kinds of expenditures do we have for capital goods? Things that are going to replace capital goods that we already have that we've worn out, or capital goods that we're going to add to make us more efficient, or to grow our business, to grow our capacity. And this section 3 is where we make investments in capital expenditures and other kinds of investments in the business. In a lot of cases, this will be changes in, we might be growing the business, so we want to invest more in accounts receivable support or invest more in working capital. Section 4 deals with working capital it's other cash flow items. Now, this is where we can now say, okay, we're going to expand our thought, and now we have a business that sells on credit. Now, what we're going to do is we're going to first add back the cost of goods sold. Why are we going to do that? The cost of goods sold was stuff that we had paid for earlier that was on the shelf. We sent it out and sent out those $15,000 worth of invoices. What the cash impact is, however, is our cash to buy new inventory. So our inventory purchases get deducted from cash after we add back the cost of goods sold. Now, our $15,000 worth of sales were all on credit, so we're going to deduct those from our cash flow, and we're going to add back the collections that we made on accounts receivable and our cash sales for the month. And if we do it this way we don't have to break this down and wonder, did we get it all right? We just take out all the sales and then we put back what we know our cash collections were. Here's also where our taxes are accounted for. We made estimated tax payments in January and again in April, and we deducted them from our cash flow here. Now, accounts payable is an interesting topic because we build up a level of accounts payable, all right? And that's people who allow us to use their money for a short period of time. When we increase the amount of accounts payable, we have effectively gotten a loan. We've gotten money in because we're using other people's money to a greater extent than we were. Similarly, when we pay down accounts payable, we're using less of other people's money. We've paid out those people, so that's cash out the door. And you can see that effect here where we paid down accounts payable by $500 in January, but we lifted it. We took in $750 of accounts payable increase, okay, in March. Now, it's the change in the accounts payable level. If we started out with $1,000 in accounts payable, we paid off $500, that left us with $500 in accounts payable. We raised it by $750, that left us with $1,250 in accounts payable. Then over May and June, we paid down $1,000. So now we only have $250 in accounts payable at the end if we started with $1,000. You see how that, I hope you see how that works. And then we left a couple of lines in here for you to put your own changes in. And you can talk with your accountant or your bookkeeper about what those might be. So we get a total for section 4, and then we take all of sections 1, 2, 3, and 4, and we net them together. And here we are at $905 of net cash flow coming in. It's a positive number. That's very good to see. Coming in for the month. All right. And then we add that to our $10,000 at the start. And here we are with $10,905 ending cash balance. That becomes our starting cash balance for February. And it flows like that all the way through the 6 months that I've shown you here. The real spreadsheet shows all 12 months. All right. And that's there, and that will be Philip Campbell's neverrunoutofcash.com, where you can download the book and the spreadsheet together. Now, what are those 2 lines on the bottom? A lot of businesses, for a lot of reasons, will set what they call a minimum operating cash balance number. And that's the minimum amount of cash they want to have available to them to cushion themselves against an unplanned purchase that has to be made in cash, to cushion themselves against a shortfall in accounts receivable collections, to cushion themselves against needing to buy more from a supplier to meet a big new order. For all those reasons and a number of others, including peace of mind and being able to sleep at night, a lot of businesses have a minimum cash balance target. For argument's sake, this business set a minimum cash balance target of $8,000. We always want to have $8,000 in the bank, at least. Okay? So then you take that out of your ending cash balance, and the $2,905 that's left is really your available cash. Okay? It's your cash available to grow the business, your cash available to buy a yacht, your cash available to do anything that you want with, including fulfill plans for future growth, future capital expenditures to expand capacity, all of that sort of thing. All right. Now, this is a very, very nice example because the cash flow is positive all the time, all the way across, and it builds up to a fairly substantial number by the end of June. Yeah. This may or may not happen in your business, but if it doesn't, and a lot of businesses it doesn't, because you'll have 2 or 3 months where you're building against expected future orders or things like that where the cash flow is negative, this still will forecast your cash flow that way and give you some idea of what you have available coming up. And that's its great value as a forecasting tool. Now, the next thing you do is track it. All the major accounting software programs that are out there, including the one that you're using, and I don't care what it is, they all allow you to create a P&L statement, a profitability statement. They allow you to create a balance sheet, which is a statement of financial condition at a moment in time. And they allow you to create a cash flow statement. All right. That cash flow statement will have the 4 sections on it that I just talked about. It may be formatted a little bit differently, but it'll have those sections on it. And then you use that tracking statement to compare to your forecast. As I said, most businesses track it by month. If you have a very small business without a lot of activity, you might track it by quarter. In an emergency, you might track it by the day, as I mentioned earlier. But track it you must. You have to compare the two on whatever basis at whatever time you're doing it, and find out why the differences that are there. Because I will guarantee you there will be a difference every single time you compare. And the important thing is your understanding of why that difference is there and what you're going to do to fix it. Right? And we'll talk about some of those things. So that's the key. Forecast it, track it, and then take corrective action. Now, part of your corrective action is to accelerate your cash flow coming into the business. And how do you do that? Tactically, outside the normal course of business, you might go on a promotional spree. Sell, 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 sell. Okay? Your best customers are the ones that are already existing customers, right? So you focus on what your existing customers buy and you work on them to buy more of it. You might call them up to offer a special promotion, more product that they've been buying, or related products you have that complement the stuff they buy that maybe they haven't bought before, either because they didn't know about them or they weren't convinced of the benefits of them. That's where your salesmanship comes in. Now, how does this accelerate cash? When you do that, you also concomitantly offer a discount for fast payment or a bigger discount for cash with the order. And in both cases, those speeded up payments or cash with the order will bump your cash flow coming in. Now, there might be ramifications down the road, but if you need cash flow in now, this is one way to do it. Now, as you do that, you don't just focus on your existing customers. You continue your marketing efforts and you continue your prospecting efforts. You continue your sales presentations to prospective customers to add them to your stable. You can't let up on that, because when you do, people, your prospects especially, say, oh, I don't hear from them anymore. I wonder if they're still in business. And they often won't take the trouble to find out. Now, one other thing to do, if you have branches in several different places, is to think about using just one bank to bring all your cash together every night. All right? That gets you faster availability of that cash. If you are collecting checks, for example, the clearing time for the checks is if it goes into one bank, there's a clearing period for the check in that bank, and then only then can you transfer that money to another bank, your central bank, say, or your main bank account, and then there's a clearing period for the check there too. So keep that in mind. If you concentrate everything into one bank, you get faster availability. Also, you can borrow money to get cash flow into the business. But you have to be careful to match the type of loan to what it's paying for. All right. When you offer credit to customers, for example, you create an accounts receivable. It's a short-term loan to your customer. So the kind of bank loan you would get to support that, in other words, you're supporting that by getting the cash sooner than you would otherwise. You're getting it from the bank instead of from your customer. Should also be a short-term loan. Those are called working capital lines of credit, right? If, however, you're talking about needing cash flow in order to make a capital expenditure, and you're going to finance that capital expenditure, think about a longer term loan from the bank to do just exactly that. Now, when you talk about receivables, if you're selling on credit, people say, well, I can't collect receivables faster. My customers pay me when they want to. Well, if you start to use more professional collection techniques, you can get your customers to pay you when you want them to. All right. The first thing to do is to take a close look at your credit requirements. When you extend credit to a customer, you typically set a limit on how much they are open to buy, it's called. All right. And once they've bought and once their receivables balance hits that number, you typically don't ship them or give them any more credit until they've paid down that limit away from that credit limit. You can review your customers. There's nothing to say you can't. And you could possibly tighten the credit requirements by reducing the credit limit, the open to buy amount for some of your less good customers. I might point out here that you need to divide your customers into your best ones, your middle ones, and your worst ones. And then consider not extending credit to your worst customers. Put them on credit card with order status. I was in the computer hardware construction business, building business, manufacturing business at one time, and all of our vendors thought that a real credit extension was to allow us to pay with a check, COD. That was credit as far as they were concerned. The ones that didn't want to offer us that required us to give them a credit card number when we bought. Yes, this was a small business, no question about it, but that was common in that business at that time. The third thing you can do for professional collection techniques is to call to follow up. When you send out an invoice, you make a note to yourself to call them in 5 or 8 days. Hi, how are you? How's everything going? Do you see any business hiccups that might change the way you're planning to pay? You're planning to pay us. These aren't collection calls necessarily, but they are a means of establishing yourself as top of mind in your customer's mind for payment. All right. When the customer suddenly has to decide, are we going to pay these guys this month or those guys? Whoever called them last often is the person who gets paid first. So keep in mind that call and follow up, not necessarily dunning them, but just to say, hi, how are you? We're happy to have you as a customer. Thank you for your latest order. Do you foresee any issues with it? Do you have plans? How's business? Will it go out? The typical kind of small talk that you do to maintain a relationship, a business level relationship. Now, you can also, as I mentioned, use revolving lines of credit to help support those receivables to get the cash before the customer pays you. And if you want to get the cash even faster and remove the issue of the accounts payable, you can consider a technique called factoring. Now, this is useful in a few industries. In factoring, you actually sell your receivable to somebody who's going to go through and collect it. And typically, when you're selling those are receivables that won't be due for a number of months. You wouldn't sell a 30-day receivable, but you might sell a receivable where you weren't going to get paid for 4 to 6 months. This is especially true in the apparel industry, where a producer might ship goods in July and August to the customer department store and not be paid until December after the store has sold through the goods. All right. Now, that happens to be quite an expensive way to do it because the factor is charging you a high interest rate for the loan he's making you, and he's charging more for the time it's going to take to collect that receivable, and he's charging a premium for his profit is a profit-making business. Okay? You can also collect receivables into your bank a little bit faster if you use a lockbox service. Now, very small businesses don't need this because the volume isn't big enough. But if your volume is big enough, you can use a lockbox to bring money into the bank without ever having it stop in your office. In the normal course of events, people might send checks to your office. Your accounts receivable clerk has to record them. They have to then endorse them. Then they have to take them to the bank. And that might be a day or two delay depending on your volume. Whereas with lockbox, the first place it goes is the bank. The bank records the check and starts the clearance process, and then it sends you all the information that was on the check and that came in with the invoice so that your person can then record that receipt after the fact in the company's books. So we're only talking about a couple of days here, but if you're talking a business that processes millions of dollars a year, that adds up. And that's why we talk about it from an acceleration standpoint. Now, decelerating cash out. The same way that you analyze your customer list for your best, middle, and worst customers, you analyze your vendor list. The most important vendors, the next most important vendors, and the guys that are, well, least important. You buy from them very infrequently. You don't need as much of what they sell you, and so forth and so on. And then you prioritize that list. Who are you going to pay first? Who are you going to pay next? Who are you going to pay last? And when you do that, you need to communicate to your vendor what's going on. You need to communicate to your vendor that you're doing this prioritization. You need to communicate to them that this is hopefully a temporary aberration in the way you're going to pay them, and you expect to be back to normal business terms with them within a certain period of time. Okay? This is for sort of the ordinary slowdown sort of thing. When we have the beginnings of a recession or a local recession. But it's important that you communicate to tell your story to the vendor so they know. They don't, and otherwise they just see that you're not paying them. And then they start into their non-payment routine right away. If your file has a note that, oh yeah, these people expect to be slow for the next 2 months, they're going to slow pull us a little bit and then catch up in month 3 or 4, that's a much better story. That's a much better maintenance of that relationship with your vendor than it would be if you just went silent. Didn't order anything, didn't pay them. All right? So communication throughout here is important, especially when you're talking with shareholders to whom you owe money or will owe money. Okay? Now, you can also, in decelerating your cash flow out, you can also cut expenses. Now, that's easy for me to say. The same way you analyzed your vendors and your customers, you analyze your expenses. You classify them. You analyze the payroll very carefully. You classify your employees. Now, you can't slow pull your employees. You have to pay them on time. But you can do things like looking at functions that your employees perform and maybe cutting hours on some functions that aren't critical to the operation of the business. They're not part of the critical path of goods, services to customers. You can analyze outsourcing opportunities. These days, you can outsource everything you do in a business except your mind and your business concept. And although you can do that, I highly recommend that you look at where your business creates the most value. What are the things that you do that create the greatest value for your customer? And when you find those things, you keep those things yourself. And you outsource everything else. You can outsource marketing, for example. You can outsource human resources. You can outsource accounting and bookkeeping. All right. But remember that whatever it is that adds the most value to your business is the thing that you want to keep a good tight hold on. You can subcontract the actual performance of a service in business, for example. But the service you're providing is what adds value, and that's what you want to keep a hold of. Now, down at the bottom, you know, at some point, you get to the point where you just have to do without for a while. do without the janitorial service and see if you can keep the place swept out yourself or with, one of your production employees that you can put on the job. However, whatever you do, don't eliminate your marketing and prospecting. Because when you do that, again, you disappear from the marketplace and people say, oh, I guess they must have gone out of business. I haven't heard from them in a long time. Keep a visibility in the marketplace. You can reduce your marketing. You can make the impacts less frequent or less impactful by spending less money on an ad for a smaller ad and things like that. But don't eliminate it, whatever you do. If you have a customer base, your average customer base is going to turn over completely every 4 or 5 years, 2, 3 years, 2, 3 months. And you've got to be able to replace those customers that you used to have that have fallen away for whatever reason. So don't eliminate marketing. That's the major message. Now, in an emergency, this seminar was originally written in the early days of the pandemic. And in an emergency, everything just stops. For that first month or two of the pandemic, that March and April of 2020, everything stopped. So you have to take really emergency steps to preserve your cash so that you can last through the period. And that includes things like active deceleration negotiations. Talk to your vendors. Hey, this is an emergency. I need you to let me buy and build my credit for 2 more months, 3 more months, and then I will catch up over a period of time. Talk to your landlord. Can I delay the rent for 3 months? Can I take a 3-month rent hiatus and spread it over the balance of the lease to pay you back? Okay. The whole strategy is delay the payment and catch up. Delay the payment, catch up later. Similarly, you want to do the same thing with your bank. You want to be upfront with them and say, look, this is an emergency. Everything has stopped. Let's talk about what we can do together to handle this term loan or this revolving credit that needs to have, something paid down on it every month. And again, the strategy is the same. Delay and catch up. Come back to delay and catch up. Now, on the positive side of the ledger, you want to accelerate even more. For example, if you're in a service business, go out to your customer base and offer them a prepaid service contract and sweeten it up by saying, I'll give you 14 months service for the price of 12 if you pay now. Okay? In all cases, whatever the promotion is, it's if you pay now, right? Prepaid subscriptions, same thing, 14 months for the price of 12. Gift cards, okay, pay me now and I'll provide service to you later, all right? Gift cards were especially popular by restaurants during that period of time because the restaurant was closed, so they could get some cash for the gift card, and then when they reopened, they would provide the service to the customers. If you do business with the government, often there are advanced contract payments that are called out in contracts. You may be able to negotiate to extend or change those a little bit. If you have regular customers that are on contract, you might offer them a new contract if they'll provide you with an advance against performance. And then finally, you have the panoply of disaster and relief loans that are available from various government programs. The state of New Mexico during the pandemic and the city of Albuquerque both had grant programs to support local businesses. The federal programs, the principal one was the pandemic payroll protection program and the economic injury disaster loans that were offered by the SBA or by banks with SBA guarantees. So those are all places to think about. And you may be able to think of several others, but these are just the ones that come to mind really quickly. Now, you're going to keep records. Stay up to date on your basic bookkeeping. Keep your books up to date. The reason for doing that is that it's much less overwhelming as a task if you do it on a regular basis, once a day, once a week. Okay, don't wait till once a month because then it starts to overwhelm you. There are a lot of relief programs, as I just mentioned. Each of them had specific requirements for qualification, for expenditure, justification of expenditure, and so on. And you need to have the records to support those. Each program had its own set of requirements. What is that program money for? What do I get to spend it on? All right. Now, to do that, what I tell everybody and told everybody was to establish sub accounts in your bookkeeping system. Your accountant can help you do this for each loan and grant so that you could say, I got money in from this loan. I spent it on these expense items. I got money in from this grant. I spent it on these expense items. And you make sure that those sub accounts cover the allowable expenditures of that money. Even though we've said, and even though you may have seen on TV, that the feds haven't necessarily gone out and audited things yet, nor did they necessarily spend a lot of time up front on qualifications. You have to be prepared to be audited after the fact because all of these programs have an audit provision in them, okay? Where the feds may come to you 2 years from now and say, okay, we want to see all your payroll protection program records, okay, to be sure that you were qualified for that. Beyond bookkeeping, beyond the basic entries in your books, you need to keep the supporting documentation, the payroll records from your payroll processor, your lease, your utility bill file, invoices for materials purchased, invoices for goods and services purchases. You got to have an evidence of the payment or the receipt to satisfy the audit folks. All right. And it's the government. If they show up, they're going to work until they're done. They're not going to run out of money and leave in the middle. So you have to have all of those records available to you for that purpose. Now, working with your CPA and or your bookkeeper is the best way to understand what the requirements are and what records you have to keep and for how long. So that's a resource. You don't have to do it all by yourself. You can use your CPA, you can use your bookkeeper to go through each of the programs that you're taking advantage of, set up the accounts in your accounting system, set up whatever you need to do for files to be sure you can quickly and easily access all the supporting information for those programs and those items. Now, here are some other resources that you can look at. I'm not going to go and read all of them. I'm going to mention one or two. This will be on the copy of the slide presentation that you get. And I want to point out the Philip Campbell website, neverrunoutofcash.com. That's the third item there. There's a book, there's a companion audio CD, there's the spreadsheet that I talked about is all downloadable. And that's a detailed approach to taking control of your cash flow. If you think that this seminar is a spoonful of sugar, then neverrunoutofcash.com is the other pound of it in your pantry. Now, I'm a volunteer with the SCORE Association. You can go to albuquerque.score.org. There's some cash flow information there, a quick guide. Staples, the office supply people do things. The SBA provides information. The National Federation of Independent Businesses, who contributed some items to this presentation, are also a good resource for you. The SBDC's library, the New Mexico SBDC library up there at the top, is a good resource, and so is Inc. Magazine, which maintains a huge library on its website for you to browse through, looking for cash flow management articles. Now, also, we're still in the pandemic, and I keep saying we're not out of the woods yet. Things aren't over yet. So these are some business resources for people who are provided by the state of New Mexico or OSHA or the CDC and so on. The Equal Employment Opportunity Commission of the government actually has some activity there, and then New Mexico's Economic Development Department also has things. You can see that at the bottom. So here's some more resources for you to pursue after this program is over that you can work on and think about. Now, getting a hold of SBDC is pretty easy. The website, as I've said before, is newmexicosbdc.org, nmsbdc.org. The email's right up there, just info@nmsbdc.org. And there's a couple of phone numbers there for you to try as well. And they are available and can provide assistance and counseling. The SBA itself, the website for the overall SBA is sba.gov. Now, if you're talking about calling them up, there's an 800 number there. I will tell you that during the pandemic, they have had huge demand for in-person telephone conversations, and you might wait a while. The email for the people involved with the Economic Injury Disaster Loan Program is disastercustomerservice@sba.gov. Right? There is an SBA district office in Albuquerque. It's in the federal building at 400 Gold. You can make an appointment with them. We haven't published their phone number, but it's easy to find online. I want to acknowledge Philip Campbell and his book, Never Run Out of Cash. He was gracious both in what was printed and what he talked to me about on the phone as I spoke to him in developing this program. The National Federation for Independent Businesses provided information, as did Inc. magazine, and the Albuquerque chapter of SCORE also all participated in the development of this seminar. We want to thank them very much for their participation. Now, if you have a question, this is a great time to ask that question. And I see we've got here right now. Heather asks, are there any rules of thumb regarding how much cash an owner should have on hand before starting a business? Typically, Heather, what we say is that when you start the business, yes, I'm answering the question live. When you start a business, you should have available the money you need to invest in fixed things like equipment, office furniture, computers, all of that stuff. In addition, you should create a forecast of what your business is going to do in the first year and how much cash you might run short of during that first year. And that you should plan on having that much cash at least, plus a cushion, on hand. Some people say, look at your forecast and look at 6 months worth of expenses and try to have 6 months worth of expenses on hand. Now that assumes that you don't make any sales in the first 6 months that you're open. I think that's a little conservative. At the conservative end, you'd look at your expenses and keep 6 to 9 months, have 6 to 9 months of expenses in the bank before you start the business. Now, a best case scenario would be to look at your forecast and look at the months in which you're expecting to lose money, add up the money that you're going to lose for those months, and have that much money in the bank, plus, say, a 10 or 20% cushion. So that's another way to look at it. And of course, the best way to look at it is to look at it and say, oh, I'm going to make money from day one. That's a little bit too sunny an outlook for me to latch onto. But the one that says what you're going to lose in the first 6 to 9 months, have that on hand plus a cushion, is probably the way I would go. The more conservative rule, of course, have 6 to 9 months of all your business expenses in the bank. And it varies business by business. So that's as good as I can get for you there, I think. I would direct your attention to the chats, the chat window. There's some information posted there by our moderator, Annalena, and you can use that to good effect. I would copy and paste the links that are there because they'll go away when the seminar ends. You just open up your Word document or a notepad or something and copy and paste the links that she gives you there. We have another question this time for, Heather's saying thanks. So thank you. You're welcome, Heather. And please feel free to ask any other questions you want to ask. I would appreciate it. Even if a question doesn't occur to you right now and it occurs to you later, you can send it to you can send it to nmsbdc.org, info@nmsbdc.org, and they'll forward it so I can get an answer back to you. Is equipment depreciation, Heather asks again, is equipment depreciation something I can do myself? It seems complicated. Well, to the extent that you have to depreciate equipment for accounting purposes, the usual process is fairly straightforward. It's the cost of the equipment divided by the number of months that it's going to be useful to you, minus after you account for salvage value. That's not real complicated, but you can do it yourself. You can look up the basic equations online by Googling around. When it comes time to doing taxes, your accountant will probably write off any equipment you buy in the year that you buy it, because that's available to you now, thanks to the tax laws. It's called a Section 179 deduction. I think the current limitation on it is several $100,000 in the course of a year. In addition, Congress, in response to the pandemic, passed what are called additional bonus depreciation rules that raise that amount even further to let you write off more stuff in the year in which you acquire it for tax purposes. Okay, for accounting purposes, you need to know that your equipment is deteriorating. So in your financial statements, and especially if you have to provide financial statements to a bank, you're going to want to record depreciation every so often in order to have a clearer picture of the age of your equipment in relation to its cost, in those terms. So if anyone has other questions, again, I'm happy to answer them at this time. If you don't, then I will very much say thank you for your time and attention. I appreciate it greatly. We're going to go on to what's next. What's next for you, my recommendation, which you can take or not take, is to take what you learned today, go home and start forecasting your cash flow. Get that template and go forecast your cash flow. Start tracking your cash flow. Do it. It's 4:30 in the afternoon. Start today. Start tomorrow. The sooner you start, the sooner it will have benefit to you. That's what's next. So we got one more question that popped up here. Michael asks, what is considered a good cash conversion cycle for a retail business? Retail is all about turning over inventory, and you have to balance the amount of inventory you have so that you give your customers the greatest amount of choice against the cost of keeping that inventory around. In a lot of cases, you'll have to be supporting that inventory with a short-term line of credit for inventory purchases, which can be expensive. What I say to retailers is that if you're not looking at anywhere from a 4 to 6 times a year turn cash conversion cycle, so it's 2 months to 3 months, then you want to be looking for something that will move faster, and just do that. That conversion cycle is critical because you get your profit off it that you can reinvest in the next round of inventory or the next round of distributions to the owners. Okay, so I say try to have a 4 to 6 turn run per year. If you're looking at small dollar items, that's easier to achieve. If you're looking at large dollar items, that's not as easy to achieve. For example, RV equipment dealers might have a huge amount of inventory on the lot, and they might not turn that inventory all in a year. They're getting some support from the manufacturer in terms of the manufacturer paying floor plan interest, but that interest typically they'll typically pay floor plan interest for 8 or 9 months. So that comes to a once a year or once a quarter a year type of turnover. But smaller retail items, stuff that costs $50 and less or $100 and less, you want to be turning that inventory over as rapidly as you can be. And 4 to 6 times a year for turnover is a good rule of thumb. So, and that takes care of those. So you all know what's to do next. You all know how to forecast. You all know how to track. You all know how to get more information about what's happening and where it's happening. So go forth and do it. You can go to NMSBDC for further training, business counseling, loan application assistance, the variety of other resources. This slide is here to point out to you that you will receive a survey via email after this presentation. If you liked what you saw, I'm Tommy Thompson, and this is NMSBDC. If you didn't like what you saw, this is Mortimer Snerd and nobody you ever heard of before. So thanks very much for your attention. That's our show, and I hope you go forth and manage cash well.
Thank you so much, Tommy, and thank you everyone for your attendance. We really appreciate it. Have a wonderful afternoon and remaining work week ahead.
Oops.